Hello everybody, it is Halo here, and in this video I'll be explaining my models that I use to trade. So in this video I'll be covering two models predominantly that I trade, with the last one being a mixture of confluences that I use to go ahead and just take certain trades that might not present themselves, right? So again, if you guys haven't already, get your notes, write them down, study what I'm saying, back test, forward test, and then implement it within your trading if need be. All right, let's start. So some foundational information to go ahead and start off with. Halo's entry models will be covered in this video, how to use them, key things I look for, and entries will all be covered in this video. Okay, so again, I suggest you guys paying attention because Model 1 and Model 2 are vastly different in terms of difficulty. Model 1 being simpler or easier, Model 2 being a little bit more difficult to go ahead and implement on a, let's say, a new or an inexperienced QT trader. So go ahead and pay attention and we shall begin. So understand before utilizing some foundational information that will be necessary before I go ahead and begin my explanations of my models. So key implementation for every model that I have. Every model that I will be mentioning in this video is built around cracks and correlations. As mentioned previously, cracks and correlations will indicate not only your entries, but also your exits. Sequential SMT, PSPs, premium and discount, crack and correlations are all major ones that I use in my trading on a day-to-day basis. So again, I use crack and correlations as the base of my trading to enter and exit trades. Sequential SMT, PSPs, premium and discount, a big one. So stay wary of that because I'm going to mention that a lot in this video. These are all stuff that I use every single day. And if you aren't experienced at catching or looking at sequential SMT, PSPs, premium and discount, my model or my models might not be the best thing for you guys to implement when you're trading. So do some self-analyzation and realize what you guys are going ahead and catching, and realize what you guys are doing when you're trading, and know if you are capable of catching similar trades to me, right? True opens and NXOGs, right? Or NDOGs, NWOGs. I put X because it'd be NWOGs or NDOGs, whatever it may be, right? True opens fall in the category of crack and correlations as well. They do, because I do look at true open, crack, and correlations with when one asset class goes above or the other one fails to close above, or if one asset class goes and touches above or touches the open and the other one fails to do so. I use them within my trading religiously to identify premium and discount throughout the day. And it's not a price-based premium and discount like many of you guys think it is. Like, oh, Halo, are you swing grading a range that has true open attached to it? No. I use it more as a revolving premium and discount, right? So I look at it, if we're above true day open, above true New York open, and above market open, I'm usually looking for shorts. I'm not looking for longs, right? If we're above true week, above true New York, above true day, I'm looking for short. If we're under all those, I'm looking for longs. So that's how I use true opens to go ahead and reference my trading, or my model within my trading. Also too, NWOGs and NDOGs I'll be going over in another, or later in another video, which you guys will also understand. But yeah, let's continue on forward to Model 1. So super anticlimactic. My first model incorporates the basic understanding of structure, sequential SMT, and PSPs. It does not deviate far from what Dave mentions in his videos, right? My first model is the most basic one out of them all. It is simply just using sequential SMT with a PSP that has an open close divergence, or a TPD, and the entry is either in the lower time frame, meaning the 1 minute, or it's after candle 3's opening price. Right, so when candle 3 opens, I enter. Now, I'm going to bounce real quick to my other chart, which is right here, which I go over this, right? So let me show you guys. Here in price, on the 15 minute, I'm going to show you guys real quick. This is the same screenshot, right? We have internal high right above true day open as well, right? So true day open, internal high above true day open. Then you have OTE of the first expansion leg that we have after mitigating the highs. And then we have a 15-minute PSP that closes under true day open, right? Now, notice how ES closes on it. So 15-minute PSP, in this case, will be a TPD alignment because we have 90-minute cycles of sequential SMT at the highs. And then we form a microcycle hidden at these internal highs as well, giving a validation or continuation lower to low of day, right, which is down here, right? So this is utilizing optimal trade entry, internal high, the range of the first expansion, alongside with the sequential SMT already formed, and your 15-minute TPD alignments, right? So this is a basic copy of what I'm going over in this, right? Exact same thing. This is not a PSP with, or it's a PSP with an open close divergence, which is default with the TPD. But in this case, it's simply just a sequential SMT with a TPD alignment, right? That's all it is. And I use that pretty well with true day opens. Notice how I put it, how I use true day open as a reference. I'm selling above true day open, right? You're not really selling under it. So you're looking for shorts. Candle 3's opening price wouldn't be ideal. You'll wait for price to go ahead and come back up above true day open and then re-short or short if you haven't already, and then continue to go lower, right? So my model 1 is super simple. It's not difficult to understand. I go over this a lot in the open close divergence video. So if you want to have a deeper understanding of that, watch that video. It's super, super useful if you want to understand my model 1. And also to the TPD alignments. Again, super simple, super basic stuff that anybody can really do. Right, now going into a more complex one, my model 2. Now, if you guys haven't already seen my fractal PSP model, I highly suggest watching that model. It's very, very important to watch that model if you guys haven't seen it already, because that is basically my model 2. Right, this model has a lot of more moving components. Fractal PSPs, PRCs, distribution candles are a huge part within my trading. This concept is built around premium and discount of ranges, optimal trade entry if need be, and lower time frame cracking correlations, all right? Which can also be used not only for continuations, but also for reversals as well, complete reversals. So if you know when to use these type of, or when to look for reversals and use fractal PSPs as a reference point, it's going to be golden. So on the right, I have the basic limitation of what a fractal PSP, PRC, or distribution candle will hold, and I'll also go over this in my TradingView chart as well. The basis starts off with lower time frame sequential SMT, then going to your fractal PSP, PRC, or distribution candle. If you want to learn more about that, watch the fractal PSP video. And then a trade to EQ, meaning you trade to EQ on at least all the asset classes, or a trade off of it utilizing the time frame given from the lower time frame sequential SMT, meaning if you have 90-minute cycle sequential SMT and you have a fractal distribution candle on the hourly, once EQ gets tapped, you're looking for a 5-minute open close divergence or any 5-minute cracking correlation to confirm that continuation to sell side again, or buy side depending if it's bullish or bearish, okay? And I'm gonna show you guys an example right now of how this looks like. So in this case, I graphed out the candle right here. Notice how we have 90-minute at the highs. We created a Q1, Q2 where NQ took out Q1's high and ES failed to do so. And we also have it Q2, Q3 where YM took out Q2's high and NQ and ES both failed to do so. Now, after having Q1 and Q2 sequential SMT, you would ideally think that this 9 a.m. candle would be your fractal PRC, and you will be incorrect. Why? NQ is the only asset class that actually opens under the 25 percentile. This 10 a.m. candle opens under the 25 percentile, whilst ES opens above equilibrium, and YM opens above absolute premium of the range, meaning this candle, the likelihood of this candle's low being seeked and then having EQ get hit and then a redistribution lower again is minuscule. So you need to have all the candles have either one or have at least a minimum of 2 assets have a similar candle structure with an opening under equilibrium, ideally under the 25 percentile, a mitigation of that low, 2 EQ, and then continue to go lower. So this 9 a.m. candle is obsolete. Even though it's a PRC, it's not useful. Why is it not useful? Because every single asset has a different, I wouldn't say shape, but every single asset opened differently, right? And the likelihood of the candle being rated, this 9 a.m. candle being rated at 10 a.m. and coming back up to EQ and then redistributing lower is minuscule. Because in that case, you would have to have YM take out this high, which it doesn't need to take out, to then redistribute lower. So in terms of premium and discount, this is not ideal. Now, what happens after the 9 a.m. candle? We take out the high of the 9 a.m. candle at 10 a.m. And then this is when you would assume, okay, in terms of delivery, all these candles should start going ahead and forming relatively the same. in which it happens, right? The 10 a.m. candle for every single asset class is usually, it's basically a copy and paste on every single asset. Every single asset has a similar 10 a.m. candle, right? So what do? You have a 10 a.m. candle and you have true week open. Remember that I use true week opens or true opens and N1s and N-dogs religiously within my trading. You can use this exact same model for your trading as well. So back test it, forward test it, and tell me how you guys like it, right? So 10 a.m. candle, anything under this 10 a.m. candle is manipulation. Anything under that is manipulation. I am not expecting that to go ahead and sustain itself for long periods of time. Meaning any move down is going ahead and is being manipulated to then go back up higher. Now, remember how I mentioned, I use true opens as a reference in premium and discount. In this case, true week open is my reference for premium and discount, where I want to go ahead and long and where I want to go ahead and short. Ideally, want to long under true week open. So what happens here? We mitigate this 10 a.m. low. Anything under this wick is valid manipulation or area of manipulation. And before I get questions saying, oh, Halo, but we're under true week open on ES. Yes, ES closed under true week open. But again, use your logic. If ES closed under true week open and we're under true week open and we haven't yet seen it on NQ and we have to manipulate that low, terminus of the manipulation might be somewhere underneath that true week open or potentially at that true week open. Okay? Meaning once we come back up into equilibrium of that PRC, PSP, or distribution candle, we are now above true opens on two assets, ES and NQ, in which we now can short continuation lower, and I'm going to show you guys now. So you go to your lower time frame. Once you have this and you're looking for manipulation, you can go down as far as a 1 minute. And before I get roasted about, hey, Lo, that's not how you're supposed to do it. When you're looking for reversals to then come back up into price like this, and you have a valid fractal PSP, PRC, or distribution candle, you don't have to refine all the way your entry from the 5 back down to the 1. You can if you want to be safe, and it'll give you the same result, but it's not necessary. So in this case, as I mentioned before, 10:59 p.m., 11 a.m. open, we go up high, we come back low, we come crashing all the way low. Now, guess what happens? PSP, does it tap true week open? No. Invalid, I'm not looking for that PSP to be held. So what do? I take the first PSP under true week open or the first PSP created after we tap true week open. In this case, it's this PSP right here. Stops at the internal low. Your take profit when any asset takes equilibrium. So in this case, for NQ, it would be this candle right here. This candle is when ES, this 1228 candle is when ES taps equilibrium, in which we then go ahead and confirm that we've mitigated equilibrium on at least one asset class and we can officially look for shorts. Now, piggybacking off of what I mentioned before, you're under true week open, you can now look for a valid long area, which we already found that already, right? We mitigate equilibrium, and now we're back above true week open, meaning what? Your 15 or your 5 minute time frame, my apologies. What are you looking for in price? You're looking for a 5 minute PSP with an open close divergence. 5 minute PSP. This is a candle that actually mitigates EQ on ES. Candle right after forms a PSP with an open close divergence, stops at the internal highs, and then you can catch a redistribution above true week open, by the way, all the way down to previous day's low, which is an 18.02 risk to reward ratio, right? Risking 13 points to make 247. It is that simple. It's not difficult. Again, a lot of moving components, but once you master it and once you learn how to refine your ranges, it becomes super, super, super easy. All right. Now we go back to what I mentioned here. So continuing off of this, Model 2 is a model that will be difficult to use if you lack experience trading quarterly theory. Once you get the hang of it, you can reverse engineer price, meaning you don't have to always wait for price to go ahead and trade to equilibrium to then trade off of it. You can also trade to equilibrium in general and catch the move up and then potentially catch the move down, right? If there's a true open under your fractal PSP or PRC, and I'm going to mention this in part 2 of the fractal PSP video, you can go ahead and use that true open as an area of confluence and then catch a trade back up to equilibrium of that range and then continuation back down lower. Okay, this is the basis of the models I use. And Model 3, which I don't have a slide for it because it's a conjunction of, or it's a combination of multiple things. You're basically mixing confluences together, premium and discount, internal highs, internal lows that are potentially in discount, swooping those internal lows, and then watching EQ get hit on at least one asset class or low hanging fruit, whatever it may be. Okay, so Model 3 is basically a mixture of confluences in conjunction with Model 1, right? And that's all it really is. It's nothing too crazy, right? If you guys want to have a more detailed explanation of that, please feel free to go ahead and watch my trade recaps. I did have a trade, or I have countless trades on where I take it off of Model 3, but Model 2 and Model 1, I go over pretty religiously with my trade recaps. So if you want to have examples or more references, watch the recaps within the Discord. And that's it. Hope you guys enjoyed the video, and I'll catch you guys later.